Let's also cut across to Andrew Colquhoun, head of Asia Pacific Sovereign Ratings at Fitch.
Our current view underpinning the stable outlook is that policy will be managed in a prudent and sustainable way. But a key test is still to come, and that will be when the rate hikes of 2013 finally feed through to the system in full force. Loan growth is still running at about 22% year on year, and banks are still fairly liquid. Our growth forecast of 5.3% for 2014 assumes that the authorities allow monetary conditions to tighten further. I think it's also worth noting that there is upside potential for regional sovereigns, as well as the mainly downside risks that we've talked about so far. If you look at our country credit reports, you'll see that we split rating factors up four ways: macro performance, public finances, external finances, and then structural factors. The final category, structural factors, is a broad category covering the level of development, governance, and the stability of the financial system, among other features. Now, for the six higher-rated emerging Asian sovereigns, which is all of them except Mongolia, Sri Lanka, and Vietnam, structural factors are assessed as a relative credit weakness. So structural reforms to tackle these various weaknesses, and they vary country by country, of course, would generally be credit positive. However, politics could get in the way of such reforms, particularly in a year such as 2014, which has a busy electoral calendar with elections in India, Indonesia in particular, as well, of course, as Thailand. For either the deficit or inflation in terms of numbers that might prompt a rating action. And as before, our focus will remain on broader management and conduct of policy consistent with retaining India's overall macroeconomic stability. So I think for us, and probably for investors, the question would be to what extent the fiscal deficit is consolidating, and whether RBI remains clearly focused on disinflation, even though there may be sort of monthly ups and downs in the inflation numbers driven by food prices and various other things. So it's really the broad direction of policy that we are interested in. Now, at the moment, given that we have the elections coming up due by the end of May, I think there's maybe two parts to it. One is obviously what we see in the short term, but then, of course, we'll be looking to see what the next government's policy strategy is once they take office later in the year. I think that is a rating-relevant factor for the sovereign, certainly, although the deterioration in asset quality for now, we haven't judged the broader risks that poses for the economy to be something that would warrant negative action on the sovereign. So overall, the position remains consistent with the sovereign's rating of BBB- for the stable outlook.